Welcome to the weekly video where I'll cover the intermarket analysis update. This is being prepared for May 19th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. In this video, we look at a lot of different things. First of all, we look at valuation, not only on a historical basis, but we look at this looking forward, and that's what the market uses. We also look at growth versus value. We want growth to outperform when the market's doing better, and we're seeing some improvements in that area. And we keep an eye on some inflationary charts that give us some insight as to what's happening there. Then we look at some other markets that we usually don't think about all that much, maybe throughout the week. Then I go through the 11 S&P 500 sectors and then compare them with the S&P. And we look at some different indexes and then some correlations. How are different markets interacting with each other? Some long-term trends. And then at the very end, I have a positive and negative list of things. So we look at valuation first. And for many years now, we see the black line, that's the S&P, above this red dashed line. Now there's a red dashed line, a blue dashed line, and a green dashed line. The green is at 10, the blue is at 15, and the red line is at 20. And that means on a historical basis, when we're above this, that we are expensive. And as I've been saying for quite some time now, we would have to come all the way down to 4,200 now with the S&P 500 to even get on the border of being expensive. We're way above this. But if you go all the way back to the early 90s, you can see that we spend a considerable amount of time above the red dash line. So that's not necessarily surprising. People can complain about the market being overvalued, but it still just does what it's going to do anyway. So I don't use this as a timing mechanism. We just look at this to say, okay, where are we in relation to historical norms for PE ratios? And then down below is the difference between where the S&P is at and how far above we are from the red dashed line. And since we've been going back up with price, that means this line has also been going back up. Then this also goes all the way back to 1980 and different events that have happened and what the valuations were at that time. And you can see we spend a lot of time above the red dashed line. Then Robert Shiller's, the Shiller PE ratio, he takes a more smooth approach using earnings and spreads them out over a 10-year period of time. Sometimes you might hear this referred to as CAPE, C-A-P-E, or the Shiller PE 10, or just the PE 10. That differentiates it from the traditional PE ratio that we've used. And right now we're coming in with a score of 36.6 because we had an up week. And to give you some perspective, here is a historical chart going all the way back to the 1800s. And then the median and the mean is between 16 and 17, pretty much the same place it's been for quite a while. So we're over double. But again, this is another historical look at stocks. What the market uses is forward-looking PE ratios. We still use the 10, 15, 20 scale. And at the bottom, we have mid caps and small caps. They had a pretty good week, but they have a lot of damage they need to repair. And they're coming in at 14.4 for the small caps. They're actually a little bit under fair value. And 15.1 for the mid caps. And both of these, especially the mid caps, is having a difficult time getting above its 200-day moving average. Then the red line, that's the S&P 500. That's what we focus on the most. We're coming in over 20 at 20.4. And then the purple PE ratio, that's the Mega Cap 8 or Magnificent 7, Illustrious 11, whatever group you want to create. On this chart, it's 8, and they're listed along the bottom. Alphabet, which is Google, Amazon, Apple, Meta, which is Facebook, Microsoft, Netflix, NVIDIA, and Tesla. Okay, and they're coming in at 25.3, but you can see they spend an exorbitant amount of time being well up into the 20s. Then this is about a week old. It doesn't change all that much here. This is looking at the PE ratio of the S&P, which is a little bit above 20 right now. And then there are some sectors in the S&P that are even more expensive than that, where discretionary, tech, staples, and industrials, they come in with a higher PE ratio. And then all the other ones that are below, with energy being at the bottom. Then we look at growth versus value. First, we look at growth all by itself. It's in a downtrend, but really making a solid comeback lately, and it had a good week. Value also bouncing back up, but also in a downtrend still. And then we do ratios between growth and value. And you can see we started to show a downtrend here with this ratio, but now we're starting to see a golden cross again as growth has been really outperforming. It didn't on Friday, but throughout the week, it really outperformed. And then this is an inverted version of that same ratio, showing how value has been underperforming. It was bouncing back as the S&P was going down, and now it's going down as the S&P has been going up. And then we look at it in a number of different ways. This first one is just using ETFs, a growth versus value ETF, showing how it's starting to be in a downtrend here, but really bouncing back lately. Then an inverted look at these same ETFs, showing how value is back now to more underperforming. And then some indexes, growth of value, showing how growth is doing a lot better and just avoided a death cross here. And then this is that same thing, but inverted, showing how value is underperforming. And I show this in the daily video, growth versus value, a couple of ETFs, where we finally broke up out of the rainbow here, where this same study, but inverted, shows how we finally broke below the rainbow as the S&P has been going up. And we look at small caps, just avoided a death cross here. We're seeing some improvement with the growth to value ratio. Mid caps are also improving above their moving averages. We're still in a downtrend with S&P growth to value, but we're above both of the moving averages, and we have been improving. And inflation, this is a monthly chart of the CRB index. We're a little bit above the moving average, and the moving average is slightly going up. Now, this is very long term. It's a monthly chart. So we'll just keep an eye on this one. But when we look down below at inflation versus deflation, we are still trending down, which means inflation has been declining. And then commodities, a daily chart, still in an uptrend, but pulling back recently. The Baltic Dry Index, which is trying to form an uptrend here, but it's been pretty choppy, but it fell down in the most recent reading. And this measures how much these are companies that ship products in the Baltics, and they're dry, okay, instead of being liquids. And usually when this goes up, that's more inflationary. When this goes down, that's more deflationary. And we look at inflation expectations, which are starting to go back up. We had some economic reports this past week that show that the economy's hanging in there for right now. So we're picking back up, but we haven't surpassed this previous high. And we look at a ratio between the previous chart, inflation expectations, and TIPS, which are Treasury inflation protected securities. We're seeing this ratio starting to go back up here. That just means the expectations are outperforming TIPS, which the TIPS are what folks get into when they're worried about inflation and interest rates going up. Except we're seeing interest rates going back up, so this ratio did dip down a bit on Friday. Then we look at aluminum, which is in a downtrend but bouncing back up. Corn is in an uptrend but coming down. Yeah, isn't that great? Wheat continues to be in a downtrend. Fertilizer, kind of keeping an eye on this. It's been going up here in relation to where it's been in the past. Lumber is also in an uptrend. It really fell down, but then it bounced back later this past week. Oil continues to be in a downtrend, still in the low 60s. And then we look at a gold to oil ratio, where gold has been seeing some profit taking, so it's been underperforming, but overall it's been really outperforming. And we look at the correlation between oil and the 10-year yield, and it's pretty strong right now. When we get a high reading like this, that means they're going in the same direction at the same time, either up or down. Gas is just chopping around here right now, but it's trying to be in a downtrend. Heating oil is in a downtrend. Natural gas, it's in an uptrend, but it's really been pulling back. And diesel, it's continuing to fall here more in the short term, and it's been declining even in the longer term. Copper, which this is what I use as a barometer for the economy, it is still in an uptrend here. Now, it pulled back and it was down in Friday's session, but overall, the uptrend is still intact. We look at our copper to gold ratio. When this is going down, that means copper is underperforming, and it was really going down, but now it seems to be stabilizing a bit. Longer term, the black line is the copper to gold ratio, and then we match that up with the 10-year and the 2-year yield. Usually these move together with each other, but we've seen a real disconnect over the last few years. Gold in an uptrend, but pulling all the way back to its 50-day moving average. Now, this is the gold ETF, not the futures contract. Silver is also in an uptrend and actually falling below its 50-day moving average. Then we look at the closing price for gold and silver on top and do a ratio. When this is going up, that means gold is outperforming, which it has been doing, but lately it's been chopping around. And then we plot this with the US dollar index down below, and we see that there's not a real strong correlation right now. They're having a tendency to go in opposite directions, where a lot of the time you can see they go in the same basic direction. The dollar been recovering lately, came up to its 50-day moving average and is so far falling back from that, but at least it's back above 100. We look at the euro, which is in an uptrend compared to the dollar, and we also plot the Japanese yen here, which shorter term, it's in an uptrend after it had been in quite a decline. So here is the euro against the dollar coming down to the 50-day moving average and starting to bounce back up. And we fell below the 50-day moving average with the Japanese yen, but now it's been able to get back above that, and it's in an uptrend compared to the dollar. The British pound coming down to its 50-day moving average and now bouncing back up. Then different index ratios. We have the weighted version of the S&P, and that's the bar chart. The red line is the equal weight version, and they're pretty much moving in tandem with each other now. And that just shows it's a more healthy market, not just a few stocks that are really controlling things. Then we look at another ratio. This is the equal weight. When it's going down, that means it's underperforming the weighted version of the S&P. Been chopping around here, not really showing a lot of conviction in 2025. And then stocks are in a downtrend compared to commodities, but stocks have been going up as commodities went down. If we still see a more positive environment for stocks, this ratio would continue to go up and eventually generate a golden cross. This shows how commodities had been underperforming, and they were starting to outperform, but have since pulled back. The NASDAQ 100, which is growth, and then a ratio with the S&P 500, which is growth and value, showing how the NASDAQ 100 is outperforming, still in a downtrend, but above both moving averages, so we could see a golden cross soon if the market stays positive. The NASDAQ, which is also growth, it's been outperforming the S&P, but still in a downtrend. The S&P 100 is just starting to come back and show an uptrend compared to the rest of the S&P 500, and that's good. These are the biggest stocks that make up the S&P 500. The NASDAQ 100 pulling back a little bit, but it had been really starting to outperform the rest of the NASDAQ. And then the mega cap growth, really seeing a nice comeback here when compared to the equal weight ratio, but we are still in a downtrend. Small caps still struggling. They came up to their 50-day moving average here with the ratio compared to the S&P, still continuing to underperform. The red line here, that's the same ratio that we just looked at compared to the blue line, which is the S&P itself. And you can see there's quite a disconnect between the two, even though they're on different scales. Mega cap growth really took a hit when we were falling down, now really starting to come back. They're still in a downtrend. It takes a while for the moving averages to switch. Robotics and AI ETF really took a hit here, trying to come back just up into the rainbow, but still underperforming when we compare it to the tech sector on a ratio basis. Small caps in the tech sector, small caps have been underperforming. That's why this ratio is going down. We spent almost the last year or so with this ratio pretty much going sideways. And we look at semis to tech. This is improving. It fell back on Friday. We need to see this continue to go up if we're going to be more positive, because we want semis to be up, and then we want the tech sector to be up, but we want the semis to do even better than the tech sector. This is what we saw at the beginning of 2024. And if we turn positive again more with the market, and things become a little more clear what's happening with the tariffs and all the trade wars and everything, and the market's liked what it's heard so far, then this ratio should continue to go up. Low volatility stocks kind of going sideways right now, and they were starting to outperform. This is toilet paper and toothpaste when you compare it to the S&P. So this ratio was going up. It's in an uptrend, but now it's really been falling back as the volatility stocks have been underperforming recently. Dow Jones Composite is in a downtrend. This is the Dow, the transports, and the utilities together, but we're coming back up here. And the Dow finally was able to cross above its 200-day moving average on Friday, and it's finally positive for 2025. Then All World, that takes out U.S. stocks. They're the ones that are doing better right now. And even though we're seeing some improvement here, when we put the U.S. stocks back into this ratio, they are still underperforming. They're going to need to see more than what we've seen so far for U.S. stocks to come back in the lead. And we've been seeing a real shift. People are getting out of U.S. stocks and getting into stocks around the globe. And when everybody starts to do that at the same time, that usually means the party is just about over. Then energy to tech sector. Energy was starting to outperform as the market was going down. Since we've seen a reverse, even though this ratio is still in an uptrend. Growth stocks compared to bonds. Now, bonds have been doing really well, better than growth stocks. But lately, we're seeing a real improvement here with the growth stocks. Then the tech sector to the 10-year yield, showing how the tech sector has been underperforming, but trying to bounce back up. This is an inverted version of that, where the 10-year yield has actually been doing better than the tech sector, but now it's starting to come back down. Discretionary to staples. This is kind of a growth versus value type of ratio that we follow here. We're in a downtrend, meaning discretionary has been underperforming, but lately it's been coming back. Staples were really underperforming discretionary, but then started to outperform right at the beginning of 2025. Since then, staples have been underperforming. Gold, which had been really outperforming stocks, now we're seeing gold going down as stocks have been going up, so this ratio has been going down. Then the dollar bouncing up a little bit compared to gold, so we're still seeing a pretty high reading with this ratio, but we are falling back. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we look at the advanced decline lines. I show this in the daily video as well. We're positive with all the indexes here. We're above the moving averages. The longer we can stay above these moving averages, the more they'll turn up and the more positive that will be. And we look at traditional Dow theory, which is just the Dow and the transports. Transports, they've been bouncing back up here, but they've got a long ways to go where the Dow's been actually holding up better. And even though utilities are considered to be more defensive, you could make a case that they're growth because we need so much electricity going forward from here. But they really have been going sideways. Even when the Dow and S&P were going down, utilities were actually hanging in there a bit better. Look at a ratio between the Dow and the transports, where when this is going up, which has been now, going back to about halfway through 2023, that means the Dow is outperforming the transports, but we're pulling back with this ratio. That would be more positive if the transports could really start to get some upward movement. Here are the transports. They are improving, but they've got a long ways to go, and they've got a lot of overhead resistance at previous highs if they continue to go up. We look at a ratio between the Dow transports and the S&P 500, still underperforming for the most part. And then the correlation is pretty strong. So the S&P and transports, even though the transports are underperforming, they tend to go up and down together with each other, according to this chart. And then instead of using the Dow, we use the S&P 500, really making a solid comeback. Instead of using the transports, we use the NASDAQ, also making a comeback right now. Breaking that down a little bit more, we look at the equal weight, which never did make an all-time high in February when the S&P weighted version did. And we're making a nice little comeback here with the QQQs, which is the NASDAQ 100 equal weight. FANG index generated a death cross, but right when that happened, we've been above both of these moving averages. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia, the really big stocks. Wilshire, a broad market measure, really showing some improvement here, as is the total US stock ETF, above both moving averages again. ARC, which is in a downtrend, but it bounced back up. It had a pretty good week with everything else. The NYSE composite, which had held up better, it's just starting to give us a downtrend here, but it's bouncing back up right now as well. And then all stocks, which are US and international stocks, they got taken down enough to generate a death cross, but since then have been bouncing back up. Emerging markets, still holding up a little bit better. And this is one of the areas that some folks are getting into. Their PE ratios are a little bit more attractive. Their earnings potential seems to be more attractive. But then if the US starts to really recover and go up, we'll see that shift back to US stocks. High leverage loans, looking good. This is another barometer of the economy. Going back and just coming off of setting an all-time high here. These are very risky loans, and this going up just votes, it has a vote of confidence for the economy. Home builders, keeping an eye on this because we've been going up with the S&P, not going up as much with the home builders ETF. We're seeing a little bit of weakness here with the correlation between the two. We'll just keep an eye on that. Microcaps in a downtrend, but trying to bounce back up. These are the real small stocks. Bitcoin got back up over 100,000. It's just kind of stalled there like it has before. And things are looking a little better here in Japan, but still kind of hanging out at these 1989 highs. Semiconductors still in a downtrend, but improving above both moving averages with the SMH ETF. Then this is also the SMH ETF, but a rainbow is on here. We're coming back up out of the rainbow. That's more positive. The AI and tech ETF in a downtrend, but showing a real comeback lately. And then we look at a long-term view of world stocks where China's in an uptrend. And this is measured by the KST, which is a long-term momentum oscillator. We're going up with emerging markets. We're starting to roll over just a little bit in Europe. A little bit of a rollover in Japan, but we're looking pretty solid here with US stocks. And then we look at another global ratio, stocks in Europe, Asia, Australia, and the Far East, and compare it with the S&P. We came right down to this 40-period moving average, and so far we've been able to bounce up off of that. But we need to see more of an upward move here because this is a monthly chart. The momentum is still dropping down with the PPO, and it's falling below zero. Keeping an eye on bonds based on price, we came down, dropped a little bit below the 200-day moving average, and we've been able to bounce up off of that, at least for right now. The total bond ETF is in an uptrend, but it's been chopping sideways here recently. And then the stock to bond monthly chart on a ratio basis, this is showing quite an improvement. But this won't be completed until the end of May. So, I mean, we could see stocks go down and this ratio could actually start to look worse again, or it could even look better than what it's looking like right now. The Praying World Bond Index trying to get into an uptrend, but then falling back. And then we were starting to see a shift here with bonds starting to outperform stocks as stocks were going down. Now we've seen a bit of a reversal there. High yield bonds, which are junk bonds, they're just coming off of all-time highs. And corporate bonds, still in kind of a lazy uptrend, just about ready to generate a death cross here. Investment grade bonds, these are more conservative, also chopping more or less sideways. People are chasing the yield. That's why they're willing to get into riskier bonds. We look at the stock to bond correlation, they're going in opposite directions right now. So if stocks are going up, bonds have been going down, and that's why we're seeing interest rates going back up. Riskier bonds, junk bonds to conservative bonds, we were seeing that ratio really falling down as people were getting concerned about things getting riskier. Now we're seeing some improvement there. 10-year Treasury yield, after a 40-year period of time where we saw a series of lower highs and lower lows, we're now settling into a higher area for the 10-year yield. And then here, junk bonds all by themselves, just coming off of recent all-time highs and also outperforming when we compare it to government bonds with this ratio. A daily yield chart here where we're coming down, but then we started to go back up with interest rates. And we're watching that 4.5% level on the 10-year yield. That's when the market seems to kind of get a little bit nervous. As long as it's under 4.5%, stocks can still go up. Now, we got up to 4.53% this past week, and that was at least slowing stocks down a little bit, but then we dropped and we ended up closing at 4.44% with the 10-year yield. So if we can stay under that 4.5% level, that would really help the stock market. Weekly chart looking at international rates here, US, UK, Germany, and Japanese rates. And we're seeing a real drop here with the volatility of bonds coming down. That's the MOVE index. The volatility of stocks coming down. That's the VIX. And then we see that the correlation is still pretty strong between the volatility of stocks and bonds. Then we look at some ratios. The S&P 500 to short-term bonds really improving. You're going to see a lot of that in these charts here. S&P 1500 to short-term bonds showing some improvement. Broad market measure with 3 to 7 year bonds improving, starting to come outside of the rainbow. The tech sector to 3 to 7 year bonds really making a comeback. And then this was really starting to outperform as bonds were outperforming stocks. Now we're seeing a bit of a reversal, but there's still an uptrend with this ratio, with bonds outperforming longer term. And we look at the S&P 500 to the 10-year Treasury yield, showing how not really seeing much of a change here because interest rates have been going up as the S&P's been going up. So we're still in a downtrend with this ratio. And then we look at the monthly chart of the long-term bond, the 30-year bond, still in a downtrend, still below the moving average. And then we look at a long-term ratio between bonds and commodities. We're still rolling over here with the KST ratio. Then the different sectors. First, we look at just the sector by itself. I just sort these according to the alphabetical listing of their symbol. First, we look at materials, which now that the economy could possibly be doing better, we're seeing some improvement here, but materials are in a downtrend and they are underperforming the S&P. Communication, this is a growth area, really seeing a nice little comeback here. And even when we were going down, this ratio held up better. And now that we're going back up, the ratio is really not breaking to the upside. It's still under its 50-day moving average, but it's holding up for right now. Energy, which just been all over, my goodness, it was going up and down, and it's right about at its 50-day moving average in a downtrend, and back to underperforming. It bumped up enough here when stocks were going down to generate a golden cross, and then a little bit after that happened, we started really breaking down with this ratio. Financials, doing quite well, not quite back to an all-time high with this sector, and they held up better. Even when the S&P was coming down, the financials were doing better on a ratio basis. Industrials, also really heavily dependent on what's happening with the economy, really doing well here, setting an all-time high here with this particular sector, and still outperforming, and that's good. This is anticipating that the economy could still do well going forward from here. The tech sector was in a downtrend, now trying to bounce back up, and it's still in a downtrend compared to the S&P, but we're seeing some improvement here as it's been outperforming lately. Staples, which are toilet paper and toothpaste, just kind of chopping along sideways, and they're in an uptrend compared to the S&P. We saw enough of an upthrust here to cause this ratio to go up, but then it's really been coming down lately. Real estate, which is very interest rate sensitive, it's been chopping along over the last few sessions, but also making a comeback. And it was going up enough to generate a golden cross here. And then, like a lot of other things, right after that happened, we saw this ratio really break down. Utilities, which have been pretty much going sideways, and they're still outperforming even though they've been pulling back. They've been going sideways for the most part as the S&P had been going up. We look at a ratio of the S&P to utilities ratio. When this is going up, the S&P is outperforming. It had been really underperforming. We're seeing a bit of an improvement now. We need to see this ratio continue to go up to be more positive for the S&P. Healthcare, defensive, in a downtrend, and also, in fact, it generated a golden cross, but then it's just been falling apart. And a lot of that's United Healthcare. There's some not so good news coming out of United Healthcare right now, and that's really weighing down healthcare altogether. Discretionary making a comeback, but still in a downtrend, and also in a downtrend with the ratio, but improving. Semiconductors in a downtrend, but coming all the way back up to their 200-day moving average. This could be acting as overhead resistance. If we can break through this and go above it, that would be quite positive. And we look at the semis to tech ratio. We want this ratio to go up if we're more positive on the market. We want semis and tech to do well, but we want semis to do even better. That's when the market really gets moving to the upside here. Semiconductors improving. That's growth compared to the Dow, which is considered to be value, even though NVIDIA and Microsoft are in there. We're seeing some improvement with this ratio. And the semiconductor index is improving, but still in a downtrend. Weekly chart. We came all the way down to the 200-week moving average, and we saw this with the S&P as well. This level held, and we've been bouncing back up off of that. Then we still have gold performing the best so far in 2025, and now stocks have actually gone into second place as commodities have been going down. We have the bonds based on price. It's hard to see some of these. And then the dollar, and then oil is still the worst performing asset in 2025. Correlations, a pretty strong correlation between the S&P and the dollar. The dollar was starting to bounce back up as stocks were going up, so that correlation is pretty strong right now. S&P to oil, also a pretty strong correlation. And the S&P to the 10-year yield, also a pretty strong correlation currently. The tech sector to the 10-year yield, pretty strong correlation there. And then the 2-year yield, shorter term, also a strong correlation when compared to the S&P. Then some long-term charts. This is a monthly chart of the NYSE. It held up above this 12-month moving average here. This is a monthly chart, and so that's good. And the red line is still going up, but we're still rolling over here when we look at the momentum oscillator. I use the Copic curve on this chart. This is also a monthly chart with the NYSE record high percent index. This had been coming down, but now it's just barely starting to go back up. And a monthly chart of the S&P, trying to get back above its 12-month moving average, but we're still going down, trying to improve a little bit here with the momentum oscillator. And then we look at a ratio between the S&P and commodities longer term. This is still rolling over. It's going to take a while for that to turn back up if stocks continue to outperform. And global ratio here, the S&P to the global, we came all the way down to this is a 24 period moving average here. And that support level has held. And sometimes when we bounce up off of this moving average, good things will happen. But the KST is still showing some weakness. Again, this is a monthly chart, so it takes a while for this to work out. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then we look at the positive things. This is when the 50-day moving average is above the 200. So we look at copper and then the currencies, the euro, the British pound, and the yen when compared to the dollar. The CRB index is in an uptrend, as are gold and silver. The low volatility ETF, even though it's been underperforming, it's still in an uptrend. Staples also more defensive. And then all the different kinds of bonds based on price. The total bond ETF, the high yield, investment grade bonds, corporate bonds. This is getting close to a death cross here. Junk bonds have been doing a lot better, and the world bond index. High leverage loans, that's good for the economy. The NYSE composite, emerging markets. Then on the negative side, this is when the 50-period simple moving average is below the 200. We have the growth indexes. Even though they've been improving, they're still in downtrends, as are the value indexes. The mega caps improving, but still in a downtrend, as is the US dollar. The Dow Jones Composite, the FANG index, and tech. All of these areas have been improving, but not enough to switch their trends yet. And then we have the semiconductors, and I measure that a couple of different ways. The SOX index, different indexes from Dow Jones that we look at, and then some ETFs. We look at semiconductors in a lot of different ways. And then we have the Dow, which is still in a downtrend, just getting back above its 200-day moving average. NASDAQ 100 is still in a downtrend, as is the NASDAQ, mid caps, small caps, and micro caps. But all of these areas have been doing much better since we hit those lows in early April. But it's been a crazy ride along the way. Then we have the Wilshire 5000 and total US stock ETF. That's a broad market measure. And then ARK is still in a downtrend, even though it had a good week. And all stocks improving, but still in a downtrend. And Bitcoin is still in a downtrend, even though it's back above 100,000. So thank you. I hope you found this helpful. Have a very good weekend, and I will talk to you in the next video.